If you've been thinking about investing but you haven't started yet, this might be one of the best opportunity ever. Right now, the US stock market is down and people are panicking and stocks are getting crushed. But if history has taught us anything, it is that this is exactly how new wealth is made. On March 4, 2025, the US government announced a 25% tariff on imports from Canada and Mexico, causing the stock market to drop. The S&P 500 fell 1.8% and the Nasdaq 100 dropped 2.6% in a single day. Some investors panicked and sold their stocks. Others are waiting on the sidelines and afraid to invest. If you truly want to build wealth, you have to understand what happens next. Because throughout history, there has been one clear pattern every time the market crashes. Those who recognize it and act on it end up on the winning side. Hopefully, by the end of this video, you will understand the US stock market better, including how the market downturns create opportunities for wealth, why the S&P 500 is the best passive income generator, and how the biggest gains often come when others are fearful. Disclaimer here, I'm not a financial advisor, so the information in this video is for educational and entertainment purposes only. These are my personal thoughts and opinions, and they should not be taken as financial advice. Before making any investment decisions, do your own research and consult a certified financial professional. Investing involves risk, and you should always make decisions based on your own financial situation. Now, what is the S&P 500 and why does it matter? When people talk about the market, they're often referring to the S&P 500. That's basically the most well-known stock market index. The S&P 500 is an index that tracks the performance of 500 of the largest publicly traded companies in the US, covering industries in technology, healthcare, finance, and consumer goods. Companies like Apple, Microsoft, Amazon, Tesla, and Johnson & Johnson are included. The reason the S&P 500 matters so much is because it is considered the best overall indicator of the US stock market's health. Instead of tracking just one company or one sector, it represents the performance of the biggest businesses here in America. Historically, the S&P 500 has averaged about 10% annual returns, including both the good years and the bad years. That means that on average, if you invested $10,000 in the S&P 500 index fund and left it alone, it would have doubled every 7 years because of compound interest. Of course, this doesn't mean that the stock market goes up exactly 10% every single year. Some years it goes up a double digit, while other years it drops into a bear market with a drop of 20% or more from recent highs. But over the long runs, the market has always trended upward. The S&P 500 best and worst years. The market does not go up in a straight line. Some years are fantastic while others are absolutely brutal. Here are some historical examples. In 1995, the S&P 500 gained 34%. In 2008, during the financial crisis, it crashed 38%. In 2013, it jumped to 29.6%. In 2018, it dropped 6.2%. In 2021, it soared to 26.9%. In 2022, it actually fell 19.4%. And in 2023, it bounced back 24%. Even though there have been major down years, the overall long-term trend is actually upward growth. If you had panicked and sold in 2008, you would have missed one of the longest bull markets in history. A bull market refers to a period when stock prices are continuously rising or expected to rise. So if you sold in 2022, you would have missed the big rebound in 2023. This is why I don't try to time the market. What does beating the market mean? If you watch finance YouTubers or listen to investing podcasts, you will hear the phrase beating the market all the time. It means getting a higher return than the S&P 500. Since the S&P 500 has averaged around 10% annually, if someone says they beat the market, they mean that they made more than 10%. Professional hedge funds, active stock traders, and even everyday investors try to pick individual stocks that will perform better than the overall market. But here's the truth. Most people fail. According to research from the S&P Dow Jones indices, over 90% of actively managed funds failed to beat the S&P 500 over a 20-year period. That means that most professional fund managers who have access to advanced research, expensive data, and trading algorithms, they don't do better than a simple S&P 500 index fund. This is why many successful investors, including Warren Buffett, recommend buying and holding index fund instead of trying to pick individual stocks. While the S&P 500 is one of the best passive income investments. When people talk about passive income, they usually think about rental properties, royalties, or side businesses that make money with minimal effort. But investing in the S&P 500 is one of the best passive income strategies out there right now, and here's why. Unlike running a business or managing rental properties, an S&P 500 index fund requires zero effort beyond simply buying and holding. You don't have to pick individual stocks, you don't have to manage tenant or worry about operation at all. Instead, you're investing in 500 of the best companies in America, letting them do the work while your money grows over time. Even better, many S&P 500 companies pay dividends, which means that you receive cash payments just for owning their stock. This is true passive income. You earn money while doing absolutely nothing. Some companies in the S&P 500 like Apple, Johnson & Johnson, and Procter & Gamble have paid and increased dividends for decades. If you reinvest those dividends, you accelerate your portfolio's growth. But if you need cash flow, you can just withdraw the dividends as passive income in retirement without having to sell your shares. This is why the S&P 500 is one of the easiest and most reliable ways to generate wealth and passive income over time. For those new to investing, the stock market has seen it all before. Tariffs, wars, recessions, inflation, and financial crisis. It has survived every single one and gone on to reach new all-time highs. In 2018, when the US imposed tariffs on China, market actually dipped temporarily, but then rallied to new highs within a few months. In 2020, the market crashed due to the COVID-19 pandemic, but within 2 years, it had fully recovered and then gone on to hit all-time high. Right now, bank stocks are getting hit pretty hard because of fears that whatever is getting implemented right now will slow down the economy. Tech stocks, especially artificial intelligence companies, are also down because of uncertainty. Some investors see this as a reason to sell and wait it out. But that's exactly what you should not do if you want to build long-term wealth. A lot of people believe that they can sell high and buy low, meaning they want to get out when the market drops and jump back in when it starts going up again. But that almost never works. Why? Because the best days in the market often come right after the worst days. If you sell during a dip, you'll likely miss the bounce back, and missing just a few of the best days can wreck your returns. Let's look at real data from the past 20 years from 2003 to 2022 based on the S&P 500 performance. If you had invested $10,000 and left it alone, you would have ended up with $64,844, a gain of 548%. If you missed just 10 of the best days, your return would drop to $29,708, less than half of what you could have made. If you missed 20 of the best days, you would have only had 17,826. And if you missed 30 of the best days, you would have been down to 11,701. If you missed 50 of the best days, your money would shrink to 5,746. And if you somehow missed 60 of the best days, your 10,000 investment would have dropped to only 4,205, a 57% loss over 20 years. This means that missing only 10 of the best days in 20 years could cut your returns in half. Missing the best 60 days would wipe out almost everything. Now, here's the crazy part. 7 of the best days in stock market history happened during the bear markets when people were most scared. That's when investors panicked and sold at the worst possible time. Let's say you sold all your stocks in October 2008 during the financial crisis. this. On October 13, 2008, the market jumped 11.6% in a single day. Or imagine selling in March 2020 when the pandemic crash hit. Just days later, on March 24, 2020, the market had its best day in years, rising 9.4% in one day. These kinds of days are impossible to predict. If you sell, you almost never get back in at the right time, and you miss this massive rebound. With all of this in mind, I have zero plans to sell my stock. In fact, I'm doing the opposite. I'm buying more while stocks are on sale. Now, one of the best strategies that I do to take advantage of market dips is dollar cost averaging, or DCA. This means that you continue investing a fixed amount of money at regular intervals, regardless of what happened in the market. Here's why DCA works. When the market is high, I buy fewer shares. When the market is low, I buy more shares. Over time, this lowers the average cost per share, reducing risk and increasing long-term returns. For example, let's say I invest $500 every single month into an index fund. If the price is $500 per share, I buy 10 shares. But if the price drops to $40 per share, I get 12.5 shares for the same $500. When the market recovers, I end up with more shares and greater gains. This is why I don't wait for the perfect time to invest. I just keep buying. Now, if you feel nervous right now, that's normal. The market is volatile and nobody likes seeing their portfolio in the red. But history has shown that the worst thing you can do is panic sell. The people who sold in 2008, they missed the biggest bull run in history. The people who sold in 2020, they missed a rapid recovery. The people selling today, they will probably regret it when the market rebounds in the future. Trying to time the market doesn't work, but staying in the market does. So while others panic, I'm holding. While others sell, I'm buying. And while people wait for the right moment, I'm using dollar cost averaging to make sure I always stay in the game. Because I know that wealth is built by staying invested, not by trying to guess when is the perfect moment to buy and sell. And history usually repeats itself. And if history is any guide, when the next bull run starts, I'll be sitting back watching my portfolio grow, while the people who sold are wondering how they missed yet another recovery. Stay patient, stay invested, and keep buying when others are scared. As always, thank you so much for watching, and I will see you in the next one.